Hey, everybody. Welcome back to Arthur Invests. Good to be with you. And what I thought I would do this morning is share an article that came across my desk yesterday. And, I was thinking about this all kind of in the back of my mind all night, just like, how could I distill what I've learned in this article and share it with the folks that are interested in hearing this type of thing? And so this article comes, out of the time in our society where the discussion around wealth and inequality and access to resources has become front and center, right? So coming out of the coronavirus, or at least going through this, we realized that's kind of ripped off the Band-Aid in a lot of areas with things that we would have not naturally seen in a short period of time. Coronavirus has essentially just truncated the growth on some of these issues. So when we talk about wealth and wealth inequality, that is becoming more front and center. And we have a lot of folks in America who are very progressive and want to change the tax code. A lot of folks who don't feel like the rich are paying their fair share and all this other stuff. My goal here today is not to advocate for or against one side of the political spectrum. That's not really my role. In fact, I don't really want to get engaged in that type of dialogue. I tend to find that to be very divisive. But what I do think is interesting for those of us who are interested in figuring out how we can get our fair share of that wealth is not to get upset. I mean, maybe you can get upset, but maybe not get so inflamed about what wealthy people do to protect their assets and their money, but learn, what are they doing, right? The tax code is written in a certain way that incentivizes certain types of behaviors. Now, this may change as these conversations become front and center, but the reality of the matter is there's specific things that you need to understand. That one thing I would say, and what I want to do today is kind of show you some of the ways that the rich don't play by the same rules as working class and middle class. And it's important because if you're starting to try to get into real estate or you own assets, you have to understand why those are important in society and why even maybe owning a business or something of that nature is so important in your ability to grow your wealth substantially, and why it's so difficult to do that if you just have one stream of income and one asset like your corporate job, right? Or working for a company. It's a very different thing. So what we're going to do is take a peek here at an article that came out. Now, this is the backstory here. This organization here that came out, let me see if I can find there, ProPublica, got a hold of tax returns for the top 25 wealthiest people in America, arguably some of the wealthiest people in the world. Now, whether or not that's legal is probably not the case. How these documents got leaked, I think we can kind of make some assumptions. There's probably some folks that work in the IRS or whatever. I mean, I'm making my own judgments here, but who were pretty upset about this, and they wanted to try to get this story front and center. So not going to speak to the legality of how the documents were obtained, but going to talk a little bit about the content today. Okay, so the Secret's IRS files, trove of never before seen records, reveal how the wealthiest avoid income tax. This is a little bit interesting, avoiding income tax. I think what we're going to see over the course of this article is the way that they're measuring things. They're trying to change the vocabulary, which again, may or may not be fair. But I want to make sure I call that out so that, these types of things that you're going to hear over the next couple of days in the media cycles is going to really interchange the word wealth and income pretty synonymously. And that's a pretty important fact, because if you're thinking about how you get paid and how wealthy people acquire wealth and income, they're very different. Okay, so let's look at this. The first thing I'd read here is, as they were going through this is one of the things that comes out of the first paragraph, and I'll just read it out loud. Taken together, it demolishes the cornerstone myth of America and its tax system, that everybody pays their fair share and the richest Americans pay the most. The IRS tax records show that the wealthiest can perfectly legally pay income taxes, that they are only a tiny fraction of the hundreds of millions, if not billions, their fortunes grow each year. Okay, now this is something that we've known for a long time. As a proportion to wealth, the richest people don't pay proportionately the same as an income tax, because they're not the same thing, right? And I want to make sure I call that distinction. And the other idea here, when it's a little bit biased, and again, I'm not trying to be a shill for the wealthiest people in the world, but you have to call this out because most people won't read this. everyone pays their fair share and that the richest pay the most. This is actually factually still true. Even though their percentage is lower, the wealthiest 1% pay something like 60% of the total tax base. So even though proportionally their income tax compared to the average Joe is lower, that percentage point is still substantially larger. I mean, look it up. You can just do some Google search. What percentage of the population pays 60% of the tax? It's the wealthy. The top 10% pay, the bulk of the taxes for America. So, we got to be fair if we're going to look through this, but it's a fair point, right? As it compares to their wealth, yeah, it's a very small percentage. So let's keep reading. Okay, so to capture the financial reality of the richest Americans, ProPublica undertook an analysis that has never been done before. We compare how much taxes the 25 richest Americans paid each year and how much Forbes estimated their wealth grew in the same period. And so what the article is trying to draw is a correlation between wealth accumulation and the percentage of income tax that they paid during that same period. Now, again, I want to point out that the tax code, as it is in place today, is measured off of your income, what your income is, not wealth. And these are very different things. And so one of the keys I would point out is as you're starting to flex your financial muscles or grow and try to build more assets for yourself, this is the name of the game, right? The roadmap is very clear. And as we get further in this article, you're going to see the name of the game is to get to assets, multiple cash flowing, income producing, or equity building assets. That is the name of the game. And in fact, you'll see that's a huge strategy for how these folks are able to still realize earnings without actually paying taxes on it, right? Again, not saying it's good or bad. I'm just pointing out the facts. Okay, the results. Okay, and so what they were saying here is basically they're going to compare income as their wealth accumulates and just see how that percentage is. And then now they've changed the status. They're saying we're going to call this their true tax rate. Now, again, you're changing the definition of what the tax code is. The tax code doesn't measure wealth, it measures income. So what they're saying is, well, we're going to combine these two and say, what does the world look like if we did combine these two things? And the results are stark. According to Forbes, 25 people saw their worth rise a collective 401 billion, during this time period. Now, what they go on to say in the second paragraph, it's a completely different picture for the middle class Americans. For example, earners who are early in their 40s have amassed typical amount of wealth for their age for about 65 grand on average, mostly due to the rise in value in their homes. But because the vast bulk of their earnings were salaries, now I want you to catch this part, their tax bills were almost as much, nearly 62,000 over that same 5-year period. So here's what they're saying. Over a 5-year period, right, when you compare the wealthiest, and you compare kind of your average Joe, the bulk of the value of their wealth is actually in their hard assets, not their income. And then if you look at how much they're taxed because of their income, it pretty much gives back all the wealth because they've had to pay it back in taxes. Okay. So the key here that I want us to understand is the name of the game is owning assets. It's very difficult to really grow your wealth just by having a W-2 job. And it's so critical that we get folks to invest in the market or in the real estate market to start to build that. Because if you don't, you can see here, just living day to day, hand to mouth, you're never going to get ahead. Okay, I just thought this was kind of interesting because Warren Buffett is always a proponent of how he's abhorred at the tax system that he pays less than his secretary. Well, Mr. Buffett, we're actually getting a sense to see that the true tax rate, according to them, is less. It's not even 1%, right? And he's supposed to be like the grandfather of everybody as he gives investment advice, but he is giving away all of his wealth to charity. So I think you can say that, for whatever it's worth. I thought that was interesting. Okay. Oh, here's an interesting thing I thought that came out of this article, right? And so they've obviously obtained all these tax documents for these folks. Again, probably not legally. But something we want to keep an eye on here is in the coming months, they're going to use this data to explore in detail how the ultra wealthy avoid taxes, exploit loopholes, and escape scrutiny from federal auditors. Now, what I want to say here is while it's going to be very eye-opening for a lot of people, this is not anything that shocked me. Not to try to sound like a know-it-all, but I mean, if you've done any type of research, rich dad, poor dad, you've done any type of this thing, you kind of know that the wealthy think very differently about taxes. It's not about earned income. It's about accumulating assets and trying to build cash flow. And so, the idea that they avoid taxes, I mean, it's again legal. So I don't know if you could call it a loophole, because the idea is that it's legal, right? If it's legal, it's legal. Don't hate the player, hate the game. I mean, that's kind of the thought I have. Again, you can probably see where I lean on this whole issue, where it's like, this is a good point. I mean, financial education needs to be something that we spend a little more time educating folks on in the schools. Okay, we'll keep going. So they take Jeff Bezos, for example, as one of the case studies here. And, they basically pointed out several years in the past decade where he paid zero in federal income. And what they basically found out here in this highlighted paragraph is that he was able to offset every penny he earned with losses from the investment side. And then he could take deductions against those. And then basically with that, report zero income. And again, the rich, using the terms that we do in our tax code, are offsetting their income with the investments they're making, right? And so, this is really interesting. The thing that I will point out with a lot of this stuff is, while they're looking at all the growth that took place, which is fair, there is quite a bit of risk involved with investing. You are also on the hook if you lose all this money. And if you look back, while the last decade's been very well, there are stories of people and good case studies and people that I've known who've gone aggressive in real estate and have actually over leveraged themselves and gone out of business. When you open a company and it doesn't work out, for example, if you're a small business owner in this coronavirus, there are a lot of restaurants that don't show up. So there is, and again, they're not the ultra wealthy. So I want to make sure I'm fair about that point as well. But this just goes to show that owning assets, having deductions, not having a traditional W-2 as your sole source of income gives you a lot more options than the average Joe. Again, this just kind of shows a chart of the difference between your typical American household and your wealth. And the difference is that people typically think about how much they make based on their income and not about their wealth. And that's just a very different conversation, maybe even a different paradigm for most folks in America. They just don't think about it. When they get upset that Jeff Bezos' wealth, you'll see that an article will come out, oh, in the last 10 days, he's made, this many millions of dollars per minute. That's not exactly true, because it's not really earned income. This is just wealth from the stock that he has as an owner in Amazon. So anyway, I'm going to go through a couple of these last ones because we're getting long in the tooth here. But this section of the article, and it's quite a bit of an article, goes through how, the court system, what they decided on which would be considered earned income. And so the ruling from this was essentially this: the federal court said that a person needed to sell an asset, stock, bond, or building in order to reap money before it could be taxed. So what we have here is a court ruling that showed if you don't sell an asset, it's not realized income. And that's actually true. I mean, right? Why should you get taxed on something that you've not actually taken a profit from? I mean, it's kind of an interesting idea. Just because you have something in your garage, you're going to pay a tax on it, or you have a holding on it. It's kind of an interesting conversation. But then this article goes on to say, in the highlighted point here, since then, the concept that income comes only from proceeds when gains are realized has been the bedrock of the U.S. tax system. Wages are taxed, cash dividends are taxed, gains from selling assets are taxed. But if a taxpayer hasn't sold anything, well, then there is no income and therefore no tax. I mean, that is the rules, right? I mean, how can you get taxed for something that you haven't actually realized? You're not actually making income from it. So why are you getting taxed? But their argument is, look, you could sell it and you have access to it, and that's a resource. And they're obviously saying that's not fair. So again, an interesting point, something to consider. One point that does come out, and this is a game that even a little investor like myself, who nowhere near the net worth of these folks, but have done fairly well, is the ability to take loans against your assets. And I do think this is an interesting piece. I don't really know how they could change this, but let me read this sentence to you and I'll give you some of my thoughts. The vast majority of the ultra wealthy loans do not appear in their tax records, but occasionally the loans are disclosed in security filings. Okay. So here's the point that they're trying to make here. Well, Larry Ellison, so he obviously is the CEO of Oracle, and Oracle's in the tech sector, right? Big database company, old school legacy infrastructure. Here's the deal. When you have as many shares in the company that he does, you are allowed to take a loan against those. And so you essentially get leverage. And much like real estate, you can take that loan and basically pull cash out. And now you have leverage against your holdings, right? And so your position and your holdings, they'll give you a loan for that. And instead of taking earned income, you can just take a loan against your assets. And now, yes, you have a monthly note that you have to pay back, but you actually have cash that is completely tax-free. And in fact, for real estate, you can actually deduct the interest on that. And so what I did recently, and I'll just give you my own bread and butter example, is our assets have gone up quite a bit. We own quite a bit of property, and the last 12 years has been very good. And so what we did is we took a loan against some of the asset there. We pulled out, I'll give you a quick example, $50,000 from one of our properties. And that increased my mortgage to about $150 a month. And now I have $50,000 sitting in the bank just because I refinanced and pulled some cash out. Now, of course, it resets the loan. I got another 30 years. But the point is that 50 grand in real income is not something I have to claim on my taxes. Now, I will say this in my defense for this is, one, it's perfectly legal, but two, I'm on the hook for that. If I get into a situation where I can't make those payments, I'm on the hook. My credit score is on the hook. The assets are on the hook. So it's not exactly like I'm just walking away with money. I have an obligation to the bank, but it's an understanding that the partnership is going to continue because the asset is the value. So that's what these folks are doing in a lot of instances, right? They own a lot of real estate. They own a lot of stocks. Their portfolios are massive. So they take loans against that. Okay. And I'm going to wrap up here on the last couple of points. So this article is fairly progressive. And again, I'm not saying that's good or bad. Just want to point that out. But this is the kind of vocabulary we're starting to hear more and more. Aggressive new laws would likely inspire sophisticated avoidance techniques, which I believe would be true. You get more aggressive on wealth tax, you're going to find wealthy put more money and interest in figuring out how to diversify and minimize the tax burden. Look, it's human nature. Nobody in Congress, he's even super progressive on the left, is writing checks to the federal government to pay more. All right, that's just the reality of the matter. And so, yes, you can be more progressive, but they cite a few examples where they're talking about countries who have taxed wealth, like Switzerland and Spain. But here's the deal. If you do your own research on this, what wealthy people do, they have the most options in society. So if you go and you try to tax them and tax their wealth, guess what they do? They just move out of your country or move out of your state. And we're seeing some of that now within the coronavirus, right? Some of the most heavily taxed states, you're seeing migration out of those states into more tax-friendly, business-friendly states. And so that's what they found in some of these other ideas. But anyway, opponents contend that these are complicated to administer and that it's hard to value assets, particularly of private companies and property. And this is true. I mean, look, if I was going to get taxed on my assets, like that can be a roller coaster. 1 year, you could skyrocket. I mean, look at what's going on with some of the stocks, with the meme stocks, right? Well, depending on what the stock is valued in the month that you get audited or what you would call it, get it appraised, I mean, it could change in the next month just because there's a run on it, and with property taxes, I think they have a little bit more of a challenge there because you as a landowner have to pay property taxes every year. So the idea that just because the equity's gone up, you still owe taxes every year, and it's based on the value that you purchased it. So, it's going to be a little bit more challenging than just being like, that's not fair that they're making more money or that they own more property or have more wealth, because it's just not exactly that clean cut. So what do I think is going to happen here? At the end of the day, I think we're going to see more conversation around this. This is going to continue to be front and center in the discussion. We're going to see a lot more programs looking to try to create some equality. And the whole point of me doing this is to hopefully this gives you some pull back of the curtain to see how wealthy people think about the way that they approach the tax system. And again, I'm not saying that we are in the billionaire category, but you don't need to be. You can see the roadmap here. Own assets. Figure out how to get out of just having one source of income, multiple streams of income that are accumulating wealth for you. And that is really the way. Over time, you're able to deduct those earnings and then those interest rate points, and then you can start to pull money out if you need to, or just have options. But you don't get there, as you can see here, from just owning one house or just owning no assets. You have to have something that's working on your behalf. So, ladies and gentlemen, if you enjoyed this, if you thought this was interesting, I'm going to continue to do more stuff like this as I find articles. Hit like, hit subscribe, check out the channel, make some comments below. Maybe you disagree with me. I'm just pointing out the obvious. So hopefully you're creating a strategy that maximizes your opportunities here. Take care, and I'll catch you on the next one. Bye-bye.